line, be careful what you wish for because you just might get it. Right now, there is a new sort of a push to improve and extend and really add to the regulations on banks. As you can know by now, there are a lot of regulations on them, but the issue becomes whether they're good at following them or the regulators themselves are good at policing them. Senator Steve Daines of Montana joins us, sits on the Senate Finance Committee, Senate Banking Committee, kind enough to be with us. Senator, always good seeing you. You're concerned about, good intentions here, right, including extending FDIC protection, limitless protection to depositors everywhere, right?
Well, Neil, I just came from the banking hearing. We had basically one of the top regulators of the Fed, who was before the banking committee. We were pressing him around what happened at Silicon Valley Bank. Why did the bank fail? And you think about banking. Banking's about managing risk. It's true if a bank makes a loan, but it's also true in terms of bank management and regulators looking at assets and vulnerabilities. Remember back in the first quarter of 2021, the Democrats, on a purely partisan vote here, passed a $1.9 trillion spending package, opposed by every Republican, supported by every Democrat, signed by President Biden, that was going to add inflationary pressure to this economy. In fact, Lawrence Summers said that clearly. Clinton's former Secretary of Treasury made it clear. He was warning Democrats, don't do this. It creates inflation. So now we have 40-year high inflation. We have the Federal Reserve making significant moves upward in interest rates. And what happens? It creates great risk for these banks. They've got to manage that much more effectively. And I'll tell you, if you look at what happened in San Francisco, the San Francisco regulators were focused on climate change. In fact, we went right to their website. They said, what's top of mind for our work in the 12th district? That's the San Francisco district. This is back in October of last year. It said, financial risks from climate change. They were asleep at the wheel. And Neil, you compare that to the Richmond district. That's the 5th district of the Federal Reserve. They said rising rates and interest rates will need to be focused on in terms of risk management. So what you had here is you had a woke San Francisco group of regulators working with woke corporate executives at the Silicon Valley Bank. This was the perfect storm to take their eye off the ball of the real risk, which was rising interest rates, decrease in bond values, and liquidity challenges.
You know, the one thing you do learn, even before the whole woke thing, though, Senator, is how often regulators have missed some of the chicanery right beneath their noses. I mean, it's legendary now, the years that they were unaware of Bernie Madoff's abuses. And the SEC again and again was warned repeatedly about those abuses and not looking at even charges and revelations that were coming to light over, as I say, a course of years. Then there were the mortgage derivatives that were popular among institutions that early regulations strictly forbid at the time, but were being ignored. Then portfolio insurance, something that brought on the '87 crash. And with each and every occurrence, we've had more regulations slapped on and to little avail. They say that history doesn't repeat itself, but it sure does rhyme. And there are new rhymes and new crises. I'm just wondering what the answer is. Apparently, to Janet Yellen, the Treasury Secretary, a potential answer could be a remedy, a costly one, to provide limitless FDIC protection for all depositors. What do you think of that?
Well, look, first you got to go back and see what actually happened. Develop the timeline, get the facts. It's analogous to a plane crash investigation where the NTSB goes in, develops a timeline, decisions made, and look at what exactly caused the collapse of that bank. Let's get the facts first. The liberals always jump towards bigger government and more regulations. I haven't seen any evidence yet that suggests that is one of the solutions. We need to hold the executives accountable at Silicon Valley Bank. We need to hold the regulators accountable for not regulating just the basics of what's already in place. And if you take a look at where they were focused on climate change as being the biggest risk. It's right there in their October memo they published of last year, when the biggest risk that other regulators identified in other parts of our country said it's about rising interest rates. Now, I'm not a banker, Neil, but that's pretty basic. I think you're going to see just massive negligence and failures of both the executives there at Silicon Valley Bank and the regulators in the San Francisco district, let's focus on that before any knee-jerk reactions coming out of Washington, D.C.
Yeah, I don't know a lot about the woke stuff and whether that was a catalyst for this. I do know, though, that you can't control all of a sudden an exodus of investors when you were buying bonds at their height and trying to get rid of them at their lows. So I don't know whether anything can be addressed on that front, but it does make you fear that a contagion is always possible. Do you think one is still coming?
Well, you hope and pray it's not the case, and that's why I think this got the attention of everybody. And banks are re-examining their portfolios, as they should. But I tell you, we were questioning Secretary Yellen on this last year about the priorities that were going on in Treasury and the Fed. They had this myopic focus on climate change as the biggest risk. Look, Neil, when we were having that debate, California was under a massive drought. They now have 50 feet of snow across much of California. So guess what, Neil? There was climate change. Suddenly it started to snow and rain again, and it's going to heal up that drought in California nicely. The natural cycles produce that.
Yeah, you just got to be careful the fix doesn't put you in a bigger fix. To your point, Senator. Very good seeing you again. Thank you.
Thanks, Neil.